So we got some new inflation data in today, and it came in hot. So I want to show you guys the details, share my thoughts, and get yours as well. And let's jump right in. So let's take a look at the headlines together. Fed's favorite inflation gauge accelerated in January. So this is an unpleasant surprise, essentially for the Fed. And as you'll see, basically we're worried that inflation is going to stick around. Inflation firmed, consumer spending jumped in January, and Fed's preferred inflation gauge, we're talking about the PCE here, accelerates, right? Adding more pressure for rate hikes. And essentially right now we're at inflation of 5.4. And remember, the Fed wants to get down to 2%. The other thing is that, you can take a look at some of these charts. This is a good one. This is the year chart, and we're looking at core inflation. It's just kind of leveling off here, right? We're kind of in this 5% realm. Yes, it's off of the peak. And this is, again, the PCE, which is the one that Fed looks at, and we're looking at 2%, which is way down here, right? So we're pretty far from there. And chances are they're going to have to raise rates more than expected. This is something that we have talked about on this channel. Literally the Fed says every time they come out and say, hey guys, we're raising rates, we're going to keep raising rates, and we're going to keep them there. And it's been so weird with the markets that we're betting that the Fed was going to cut rates. So it doesn't seem like that's going to be the case. This is a chart from the last 20 or so years, I'd say from 2000 to now, essentially where it has inflation been. And you can see right here, we're at 5.4. So we definitely had an acceleration. You guys can see that. It was coming down, but now sort of we're just kind of sticking around. And, you could take a look at this as well. The headlines are starting to get a little bit more hawkish. We haven't seen these kind of headlines until just today, where Fed may need to hike to 6.5% to cool prices, right? So we're talking about a couple of different things. One, we're talking about where's inflation, right? So as of now, it's at 5.4%. And the Fed wants to go down to 2%. And so in order to cool inflation, you want to essentially raise the cost to borrow money, right? You're raising interest rates. And we're looking at possibly as high as 6.5%. So this is according to some economists, and we'll read the details of what they say. Our analysis casts doubt on the ability of the Fed to engineer a soft landing in which inflation returns to the 2% target by the end of 2025 without a mild recession. So they're saying this odd is tough, right? They're saying they doubt the soft landing. Also, too, they're saying here that the computer model suggested rates would peak at either 5.6, 6.0, or 6.5 in the second half of 2023. So, anyone's guess where interest rates are going, but they're just saying this is according to, it was an academic study, and I looked at the list. There's a bunch of well-known professors, but the basic gist of it, though, is that second half of 2023, the peak rate, or the highest could be anywhere between essentially 5.6 to 6.5%. All along, the Fed been trying to say in public that, maybe it'll go up to like 5.3 or something like that. So this is well beyond that, what the Fed is saying. But this is something I've mentioned to you guys all the time. The Fed always tries to give you the rosiest scenario to not freak anybody out. So whereas more like an academic perspective saying, hey, rates may need to go higher and may be elevated longer. So this idea that the market was predicting, a cut in interest rates always seems strange to me. I've said that all along. Here's some more Fed people in public. So this is Jefferson and Mester say inflation may persist and ease slowly, meaning that they think this may they use the rosy scenario that inflation will stay there, but will come down, but slowly. Here's a quote from them. This is saying here, inflationary forces impinging on the U.S. economy at present represent a complex mixture of temporary and more lasting elements that defy simple, parsimonious explanation. It's not going to be easy, and we're not going to get along. The ongoing imbalance between supply and demand for labor, right? Talking about the same stuff all the time, labor, combined with the large share of labor costs in the services sector. So basically, for example, haircuts and massages and all these things that, just kind of services, the price that you pay to get people to come back to work or to work at all is up, right? So it's hard to bring that down. So this is sort of where wages keep inflation sticky. Suggests a high inflation may only come down slowly. Also, too, there's bets now that the next rate hike due to inflation will be 50 basis points or 0.5%. So currently, sort of the betting is that there's a 32% chance. You can see right here, 32% chance that there'll be a 50% rate hike. Sorry, 0.5% rate hike, 50 basis points, right? A rate hike next meeting. I think that's like 20 some days from now, and it's up, right? So a day ago it was like 25%, week ago, and then a month ago, right? So a month ago, no one thought that necessarily they were going to do a half-point rate hike, but it looks like that might be on the table. 32% chance right now. This is sort of the the market headline: stocks hit with inflation heading the wrong way. That's sort of the surprise, and it's saying the 2-year yield at the highest since 2007. And I mentioned to you guys about this before. I mean, when bond yields are up, it's pressure for stocks. Now, as of recording this, we have the 12 months at 5%. They were dispensed 2-year 4.81, 5-year at 4.22, and the 10-year at 3.95. And I mentioned you guys before, if the 10-year goes above, I'm talking about treasury bonds here, is above 4, it makes it really, really tough for stocks, and we're right there. Also, too, so, funny headline: welcome to the 5% world where the yield chases you. This is just how it is. You got high inflation, high interest rates. Jamie Dimon, there was a headline. It was yesterday. He was saying the Federal Reserve has lost a little bit of control of inflation, so he had been a bit bearish. And I think his language, it was a few months ago, he was like saying storm clouds and these kind of things. So certainly, I've mentioned to you guys several times, be diversified and don't put all your eggs in one basket. Let's see some more quotes of what people are saying around the market. So this is over at Janice Henderson. They're saying, this was not the news the Fed or investors had been hoping for. So this is not what people wanted to hear in terms of the market people. We expect markets to adjust to the likelihood that the Fed will need to raise rates higher and keep them higher for longer than they had been pricing in previously. So essentially the market was a little bit over optimistic. Viewing the hotter inflation data together with continued strength in the labor market, consumer spending implies the Fed still has work to do. It appears investors have to wait longer for a much anticipated Fed pause, right? I'm not talking about cuts here, just waiting for a pause. So they're still increasing. This is over at Evercore. They're saying here, the likelihood of achieving a soft landing dips, so the chance of soft landing is dipping, with the risk of a no landing potential, so they're forcing the Fed to push rates. Essentially, like, the economy is relatively strong, and so is the labor market. So it's like we're not even crashing at all, right, in terms of the economy. And so the Fed needs to essentially cool off, because essentially what we're trying to do, guys, remember this whole thing is all about keep controlling inflation. And remember, Jamie Dimon's like, it's even out of control. So rates are probably going to go higher. That's what everyone's indicating, and that's sort of what the numbers indicate as well. But let's keep seeing what they're saying around the market. Potentially forcing the Fed to push rates higher and hold longer, with the greater risk that the ultimate pushes the economy into a mild recession, because the risk is if you put rates so high, then it slows growth too much. So this is what the Fed's trying to do. They're trying to balance. We got to control inflation. They got to raise rates, but also not push the economy too far into recession. So risk off, pure and simple, meaning that people don't really want to put money in the market. We still think the Fed is not so they're saying not likely to return to 50 basis point hikes, though that risk has nudged up with the latest data. And I showed you guys the risk. It was like 32% chance. What else we got here? Advisor Alliance. They're saying it is much too soon for the Fed to say mission accomplished, right? So the war is still going against inflation. It is far too early to extend duration and buy the dips in bond prices. Interesting. Let alone trying to continue to buy the dips of the stock market. So they're just like, it's too early to buy anything. That's what they're saying. We have been exercising more caution and have advised our clients to be careful and not aggressive at this point in the economic cycle. So they're quite conservative over there. I'm on the conservative end myself as well. Let's see what else they say here. This is over at the book report, and Peter Bukvar, he's got the book report. Bottom line, Treasury yields are moving higher in response to the higher than expected inflation stats. And reminder that while the trend will still be down, it will still take time for the Fed to get to some comfort level, meaning that, yes, we are trending in terms of lower inflation, but it's just, it is tough. Yes, he's saying Treasury yields are moving higher and inflation is going down, but, the inflation stats is like, it's just a reminder that, yes, the trend is down, but it's just going to take time, because what are we at, 5.4, and they're trying to get down to 2%. So it is what it is. Either way, at least looking at the core PCE, we are finally have zero real interest rates. I know some are still trying to figure out how many hikes the Fed has left, but it's not many. And again, higher rates for a longer time frame should be the focus. So they're saying, everyone's all saying the same thing, higher rates, longer time. This is Jeffrey Rotes over here. The Fed may still decide to hike by 0.25 at the next meeting, but this report means that the Fed will likely continue hiking into the summer. Markets will likely stay choppy during these months with where higher rates have yet to materially cool consumer spending. So basically what we're saying here is like, okay, we're raising rates, right? But are we raising rates enough to where, people aren't shopping anymore, meaning that you're reducing demand, meaning that you're going to, reduce demand and again, bring inflation down. So that's the whole name of the game here. And it's interesting because the last person were saying like, hey, if interest rates, for example, if inflation is at 5.4 and interest rates are also at 5.4, that's where they're getting the notion of the zero thing here. The one of the things that I was thinking about as well is like, what is the market doing? The S&P is at 3,900. I think it was Mike Wilson over at Morgan Stanley. He was saying perhaps the bottom will be 3,000. I think before the bottom we saw was it 3,600, something like that. It's anyone's guess. I tend to be more bearish just because the Fed just keeps raising interest rates. So it's tough on stocks when interest rates are going up because it should slow down the consumer, but it's not, which is crazy. So that's why the Fed's in a bind. It's like, well, do we keep raising them? And essentially what it is it's a raise and wait and see, right? But if you wait too long, it can spiral out of control. And if you raise too much, it could, sink us further into recession to farther than we would want to go. But keep an eye on this stuff. You can see though, all year, the stocks have been really volatile. Although the overall trend is down, but you guys can see it for yourself. It is up and down, up and down. If you want to check some other indicators, you can look at the Buffett indicator. This would say we're 30% higher than the long-term trend. These indicators, just be aware this is a bit past looking. So the name of the game is projecting the future. That's why we're always talking about where a rate's going to peak and things of that nature. But this would suggest overvalued. So if you look at the Shiller PE, we're trading into 28, which also suggests a bit overvalued. It's been like that for a while though. And our markets be crazy. And if you don't understand this stuff, it's basically what's the price of stocks compared to how much money the companies earn. If you want to look at something else that I watch all the time is like something like a Bitcoin. I mean, you guys can see it. It is up, it's down, it's up, it's down. And it is volatile. I myself, don't believe in this stuff. And I get it if some people like it. I get that. But I don't think there's the money printing is done. We're not doing that anymore. And so where's the money to come up to push this stuff up? This Bitcoin again. And, the one that we've kind of been looking at here in Korea is the exchange rate, the dollar. The dollar's been rebounding again. And it's just been a wild year, So since like, say, 2021, the dollar is like really went up. I think it peaked at like 14.50, something like that. This is compared to Korean won. And it has been falling, but now we're seeing this get back up again. So if the dollar, like, for example, goes into some ludicrous number of like, 1,500, it'll be like unreal. This is just unnatural moves and signals an unhealthy market. I mean, this is the dollar. And the dollar shouldn't move this much. And it reminds me that, like, as I saw this headline, a 29-year-old quits the NFL to sell Pokemon's cards. His business brought in $5 million in just 7 months. So it feels like in this day and age, we're all better off just, buying and selling Pokemon cards. You're probably better off. So forget crypto, forget stocks, forget, trading currency. Just do Pokemon, right? That's according to the, what's his name? His NFL player. So Blake Martinez. I had saw this before. He was, I think he was active on Instagram and stuff like that, talking about buying and selling Pokemon cards, but it is pretty funny. So anyway, that's the summary of what's going on. PCE is high. Fed probably needs to raise rates, and we'll see by how much. They could theoretically do 25 basis points and, maybe 5 or 6 times, just for example, and do that all through the summer. So there may not necessarily be 50 basis point rate hike this next time, but it doesn't mean necessarily they're cutting or even pausing, that they just keep raising them each meeting. So love to hear you guys' thoughts on these things. Thanks again for watching, and I'll catch you in the next video.